Hello, it's Doc Severson with Ready, Set, Trade. And here is today's trade of the day for Wednesday, the 18th of November. Today's trade of the day is on UPS, or United Parcel Service. The price has been in a consolidation for months now, since really August. Coiling up, consolidating, trying to break out, being hauled back down in the pattern. And all of this is building up a tremendous amount of potential energy. We've passed earnings, we've passed the dividend payout, and it looks like the price is ready to break out above 170 and assume leadership again. Now, let's say that I'm trading a $1,000 Robinhood account. What I want to make sure is that every trade that I execute has less than or equal to 2% risk per trade, which in this case is going to be $20. So I've got to design a trade that's going to risk me no more than $20. To me, the entry for this would be a breakout above 170. And if the price pulls down to 160, then the trade is over. That means that the breakout failed. We need to get out of the trade and look for an additional or subsequent entry down the road. Now, most retail traders will take their whole account and stick it into one trade, which is really poor form. It's hard to risk manage the position at $20 if you do that. So the best way to do that is to determine the position size based on the risk that you want. So if you want to risk no more than 20 bucks, and we're looking for a $10 price movement here, which would represent your risk, then this is quite simple. We can just limit this to 2 shares position size. So if we drop $10 in position value in the stock value with 2 shares, that's going to be a $20 loss. And then we're out. We have risk managed the position from day one and not after we enter the trade, which is usually when most people do it. We can also take this trade with options. One option contract will leverage the size of 100 shares of stock without having the same capital. The way that we would do this, instead of just buying a call option, which is how many people do it, we'd use a much more controlled instrument, such as a vertical debit spread. We're going to build up that spread by buying the 170 call and then simultaneously selling the 172.5 call, like this. And we're going to use the 24 December cycle, which is about 36 days away, which is about when we want to trade this. Normally we set up these trades about 30 to 35 days from expiration. The risk on this trade will be $125 per contract. We're going to look for about a 50% return from this trade. And if we divide this by that 2% figure that we talked about per trade risk, we're going to find that this requires us to have a minimum account size of $62.50 for us to execute the trade and to keep our risk within 2%, since we're potentially risking $125. That is today's trade of the day on UPS. We'll see you tomorrow for the next one.